There are two other themes that I would want to slightly look forward to from a 3-year perspective, right? What I basically covered in the first half was walked you through the last 3 quarters around what has performance been like, both at a relative and absolute level, what has caused earnings growth to narrow, and what have the steps been from the government and where we are today versus what we should expect in the next 3 to 6 months. Now, if you take a slightly more longer dated view, I'm not saying 10 years, 15 years, I'm taking more of a 2 to 3 year view. There are two themes that I think merits attention. A, which is already in our portfolio, and B, which will increase its weights in the portfolio at the right price. One is a sector called consumer tech, right? So, for example, we are used to consumer, we are used to consumption, but consumer tech is more of a relatively newer sector. Obviously, this sector is a very difficult. Some of these companies have platform-like characteristics. What do I mean by that? You will not see too much of competition because it takes time to build and scale such businesses. Cost of acquisition generally tends to be high in the first 10 years of such businesses. But once it's done and you have a very strong ability for you to have acquired customers and provide value, operating leverage flows into the business. So typically, these are businesses that can grow at 20 to 25% plus from a top line basis, may not translate into EBITDA in the early stages of their growth, but once they reach an inflection point, the EBITDA also begins to flow through and operating leverage comes through in a significant way, which means your 20 to 25% top line growth can translate into a 30 to 40% bottom line growth at the right point of time. The risk around these businesses also is your traditional metrics of using PE for valuation may not always be the most appropriate way to think about the business because you cannot value it on today's earnings. You will have to take a call on 3 years out. How could the business look like and give it a forward multiple? And that is where things could go wrong. Now, there are certain macros when such businesses tend to do well, which is periods of low interest rate. Now, if you look back in history, right, the period of 10 to 22 or 10 to 23 in the US, obviously, US, many of you are aware, US was the best performing market. And I've been talking about US could be one of the worst performing markets this decade. And that view is something I still continue to hold. But one of the reasons why US was the best performing market was the fact that its cost of capital kept coming down in the last decade. And hence, technology companies, which in FY12 used to be 9% of S&P 500, as of 24 is at 24% of S&P 500, which means roughly a 3x improvement in weights. And that means some of these companies have given you 6 to 10x returns over that decade, primarily because when cost of capital comes down, your terminal value of the business goes up. So you get rewarded for disproportionately for owning terminal value in simple DCF modeling. So you want all of these conditions to align itself for you to actually make disproportionate money. To summarize, you need strong growth. You need operating leverage, which means the company must have turned around in terms of moving to a negative to a positive. And hopefully, you need an environment of low or lower interest rates that will help your terminal value growth. So, that is one thing that we see as the environment over the next 3 years for India. Second is chemicals. Now, this is a slightly completely different sector. Over the last 3 years, you will see if you measure it as an industry, earnings growth has significantly dropped. It used to have a very high base, especially post COVID. It was artificially inflated. It had to get reset. But because the balance sheets of some of the companies were very strong, they continue to invest in capex. So, to put it into perspective, some of the well run companies which have strong gross margins have improved their gross block against FY21 in FY25 3 times, which effectively means today their return on equity will look extremely depressed. And as this utilization improves, you will see this ROE expand in a non-linear way. And I think this, again, this theme is going to be an interesting theme to play out over the next 3 years. It may not have an immediate effect in the next quarter or so, because you need some amount of the tariff noise also to settle down, because this is more of an export oriented theme, unlike consumer tech, which is going to be more of a domestic oriented theme. So, two themes to actually keep in mind from a slightly more 3 year perspective. And there are names in our portfolio to actually reflect both the themes. You might see more of this over the subsequent few quarters.